Hi, I'm Rick Kaler. Thanks for joining me. Recently, I heard from a reader who had just finished building a new home. He noticed something on his loan paperwork that really didn't land well with him. His construction loan rate floated 2% above prime. And this was on top of a 1% origination fee and several smaller charges. He questioned why the bank would need another 2% on top of prime. Wasn't it essentially lending out 10 times the money it held, earning easy profits at everyone else's expense? Now, his suspicious reaction is understandable. Building a home is a really stressful project. Every decision feels super consequential, and in many facts it is. In many ways it is. Costs seem to change overnight. Under that kind of strain, yet seeing another fee can activate a suspicious part of us that can whisper, you're being taken advantage of. Yet in most cases, construction loan pricing isn't a sign of greediness. It really reflects the fact that a construction loan is both riskier and more labor intensive than a conventional mortgage. A standard mortgage is secured by a finished home with a clear market value. But consider that a construction loan is secured by a plan, blueprints, and a hole in the ground. Weather delays, contractor problems, supply shortages, cost overruns can all derail a build. And if something goes wrong, who ends up with it? Well, the bank could end up with it and end up with a partially finished structure that's difficult to sell and expensive to complete. And having been a realtor in a past life, I saw many of these situations, and it never ended well for the bank. Of course, it doesn't end well for the builder or the homeowner either. So because of this, construction loans require continuous oversight. Borrowers don't receive all the funds at once. Money's released in stages, and each draw requires inspections, documentation, lien waivers, and a lot of staff time. The origination fee compensates for the upfront work. The extra spread above prime compensates for everything else that follows. So the belief that banks lend out $10 for every dollar they hold is another common misunderstanding. It traces back to the old fractional reserve model, which hasn't shaped bank lending for years. According to the Federal Reserve, reserve requirements were reduced to zero during the pandemic and have remained there. What does limit lending today is capital. Under Basel III International Banking Standards, that's a mouthful, banks must hold a percentage of their own capital against loans. The riskier the loan, the higher the capital requirement. Construction loans sit near the top of that spectrum, which means banks have to tie up more of their own money to issue them. Banks also pay interest to depositors. They borrow from other sources and maintain pretty costly infrastructures, compliance costs, cybersecurity costs, and of course their staffing, their labor. So their actual profit is the spread between what they pay for funds and what they earn on loans, known as net interest margin. According to the FDIC's quarterly banking profile, which was released on December 5th, 2024, the average net interest margin for U.S. banks was about 3%. After expenses, most banks earn returns on equity of roughly 10 to 12%, and that's in stable years. Now that isn't an egregious return for a business that wants to maintain stability. Banks also play a stabilizing role by taking short-term deposits and turning them into long-term loans, which is a basic and essential function of a bank. And when that balance slips out of alignment, the consequences can be pretty dire. And this was demonstrated by the 2023 failure of Silicon Valley Bank. So none of this makes paying an extra 2% for a construction loan any more appealing, but feeling frustrated about the higher rate makes perfect sense. That doesn't mean that that spread is a ripoff. Construction loans aren't priced to gouge. They're priced to reflect the real risk, the real labor, and the real capital that they require. In a perfect world, every new house would go up on time and under budget. In the real world, that's almost never the case. Building a house is complex, uncertain, and I would add, deeply emotional. The interest rate premium is part of the cost of turning an empty lot and a hole in the ground into a home. Thanks for listening.